Hi there, welcome to this video. This is Morris from San Jose Options. You can find us at sjoptions.com. I'm here to talk a little bit about portfolio margin trading and how you can learn to take advantage of this type of account if you study with us at SJ Options. In front of you, you have an example of some of our wins over the last couple of years. If you visit our site, you can see the entire track record. We have not had a single loss in the last couple of years, ever since we've been using our own trading software. So next, let's talk about the history of portfolio margin trading just briefly. So what is portfolio margin trading? Well, first of all, it's a margin account in which the buying power is determined by the risk. There are different models that are used to determine the risk, but basically the risk model should stress test different scenarios, such as a drop in price, an increase in price, a drop in volatility, and an increase in volatility, and time as well. So there's different risks that are involved with your option trading, and these factors should be calculated into the risk to determine the immediate risk on your portfolio at all times. So as the market changes, then this type of margining system dynamically will update and reflect the new risk in your account second by second as things happen. This type of trading is only offered to experienced traders. So typically you have to have a number of years of trading required by the broker. For example, 3 years of experience. Most brokers you'll have to take an exam. Some brokers you do not. You just have to have the capital. Most brokers require a minimum of $100,000. Some are $125,000. I've seen some brokers charging or requiring a minimum of $500,000 account just to open portfolio margin. Your TIMS model, this one is used at various brokers. It's brought to you by the OCC, the Options Clearing Corporation, which is partly owned by the CBOE. This went through a process of testing and was approved by the SEC. And there was about a 2-year pilot program, 2006 to 2008, where I went through some testing, and then finally in 2008 it was released to use for retail traders. Now, even though the TIMS model is approved for brokers to use, the brokers are still allowed to implement their own risk models. So through the approval process, the TIMS ended up becoming a very simple risk model where it measures down 10% and up 10%, and it measures that directional risk. However, it does not measure volatility risk. So from the research that I've found, it was approved in that very basic form so that many brokers could offer portfolio margin. And then to address the limitations of the model, the SEC allowed brokers to write their own risk models, but then they're supposed to get those approved as well. Okay, so some brokers you'll find they include volatility in the risk models, and other brokers don't. Okay, so because of the approval process and the complexities of options, and again, the way that the industry has given brokers the right to develop their own risk models, you'll have different risk models as you go broker to broker. So the models are not standardized. And that's an interesting topic as well, because when you put on an option spread, there's a certain risk that's defined and understood for the most part, and as you go broker to broker, the margin can be totally different. Disagreement of what risk actually is with options, and that's reflected in the fact that there's no standard risk model. So these are very important concepts that you must know and understand if you're going to trade portfolio margining. For example, if your broker uses a formula that does not calculate volatility and only calculates directional risk, then you're going to have certain limitations with that type of model. Something like a long straddle may not have any margin required whatsoever, simply because there's no directional risk, immediate directional risk, that's recognized by that type of risk model. However, that type of trade would have plenty of vega risk. With a positive vega, if the volatility drops, that trade can lose money. So there's going to be several strategies that will have risk that's not going to be recognized by the TIMS model, for example, and that's why there are a lot of brokers that do not use the TIMS. So that's just some brief information about portfolio margin trading. There's definitely a lot of benefits to having a portfolio margin account, but you really have to understand how the risk models work and how they work at the broker that you're trading at. And then you also have to understand how those risk models apply to your particular trading style. So one advantage working with us is we've been working with portfolio margin since 2009, nearly since the inception of portfolio margin trading. And we have a clear understanding of how our strategies work relative to these risk models, especially the TIMS. So in effect, through the deeper understanding of how the models work and how they relate to our trades, we're able to achieve success in a safer way. You can avoid some of the problems and common mishaps that will happen as you trade a portfolio margin account. If you do trade a PM account without the guidance, then a single mistake could cost you tens, $20,000, $100,000 instantly. So it's very important that you get the education that you need to trade this type of account. And just to give you an example of how we help our portfolio margin clients, for example, the TIMS model, when it doesn't model any volatility risk, what happens is your margin can change quickly and drastically. So, for example, 1 minute you might have plenty of buying power, and then with a rise in volatility, your buying power is zapped and you have none at all. And so that can happen if you put on a trade, for example, like a short strangle. Okay, so like that type of trade will have a strong negative vega, but it also has a strong negative VAMA position. So as soon as the volatility rises, that trade, first of all, loses a lot of money, but then your margins at the same time go way up, and then immediately you could be out of buying power. So that's just an example. But to correct something like that, you can hedge that position by balancing your VAMA so your VAMA is not negative, and make that VAMA flat or positive. So that way, as the volatility increases, your vega position remains stable. So those are things that we can teach you at SG Options. We can teach you how to use your higher order Greeks, and then this will help you stabilize your vega position. And then as the volatility shifts around, your margins can actually be stabilized as well. So it's very important to understand how to use your higher order Greeks when you're trading a portfolio margin account, and we're the only course in the world that can teach you how to do that. So I hope you enjoyed this presentation today. Give us a call at 800-862-2503. Our URL, sgoptions.com. And if you're an advisor or a hedge fund or a trading group, please visit sjadvisor.com and just mention this video, and we'll give you 10% off your membership. Thank you very much, and have a great day.